If you're trying to become a successful trader, or you're already consistently profitable but you know you could do better, what we're going to go through in this video is the most important thing. And yes, I know that's a really bold claim to make, and I'm going to have to back it up throughout this video now. But don't worry, it's not going to be anything like a super secret strategy I've discovered, or a quick hack to improve your success rate, or any of that sort of bollocks that you see on TikTok. Instead, this is going to be something that's really practical, logical, and it's right at the heart of trading, or at least it should be at the heart of good trading. But unfortunately, it seems like well over 99% of traders neglect this area, either because they're overlooking it, they don't realize maybe, or they just don't care about it. But this is something that if you understand it and you implement it, it will improve your trading. It doesn't matter what approach or method you're using, what system or strategy, whether you're a complete beginner or you've been trading for years, this is something you need to understand and it will improve your trading. So just like the last video, this isn't going to be scripted, but luckily it seems from the comment section of the last video that most of you prefer this format, which is great news for me because I hate scripting videos and it means I can give you so much more detail and value throughout the video now. But we are going to have some structure, so I'm going to share my screen. But before you click away thinking, bloody hell, all this guy bangs on about is probabilities all the time, stick around because what we're going to go through is so much more than what we've covered so far. And by the end of this video, you'll understand that you're already estimating probabilities of your trades. So I'm not asking you to do something that you're not already doing. You'll understand why it's important to explicitly estimate your probabilities and to track them, not just doing it in your head without realizing it, which is what you're currently doing, most likely. You'll understand how to estimate the probabilities of your trades. We've had this question on loads of our videos recently, the ones about probabilities, people asking, okay, how do you actually do it? And I did show you in a video about range trading that hardly anyone watched. You know, people ask for videos going through trades and then no one ever watches them, and that's going back years, but anyway, that's a whole nother topic. And then finally, we'll go through how to improve your ability to estimate probabilities. Now, those of you who have been around this channel for a while, and especially our members, will know that I'm not really the sort of person that just throws out an unfounded opinion about something. Usually things are well researched, they're based on extensive testing or a lot of experience. And this is the case here, like I'm coming with receipts because a lot of people have been disagreeing with me on probabilities and those people are wrong. And once you understand it properly, then, well, I've said this like a few times already, I'm say it a million times more, it will improve your trading, surprise, surprise. So grab your tea or coffee and keep it at arm's reach because in one of my last live stream trading sessions, I knocked over a full cup of coffee. Oh, fuck. So let's get into it. Now, there's this common phrase that I've talked about before, that trading is a game of probabilities. You've probably heard this on just about every trading channel, social media account. Most traders come out with this usually as a reason to justify their losses. Like, it's okay, we're not expecting a 100% success rate. You know, trading's a game of probabilities. Or, you know, when some indicator or tool or pattern they're using is not performing, they'll say, well, it's not meant to work 100% of the time. Trading's a game of probabilities. Now, I agree with that statement. I think that trading is about probabilities. I wouldn't necessarily say it's a game, but we're going to refer to it as a game throughout this. But the problem is, most people who make that statement, and I've said this before, their actions don't align with that. Because if trading is about probabilities, then why aren't probabilities featured in most people's analysis? But there's another problem as well. And that problem is that I think a lot of people don't actually understand the role of probabilities in their trading. And much worse than that is I don't think many trading education channels understand about the role of probabilities. And I've seen this many times because there are so many videos coming out about probabilities in trading, but they all seem to get it wrong. And there's one in particular, like in this industry, people look around for videos that they think is an interesting topic, then they'll steal all the information, repackage it with a better thumbnail and title, and it'll perform well for them. Now, that's happened to us on many occasions where we bring out information that's based on our research, that's based on, you know, our testing, our experience, whatever, and people will rip it off, repackage it, and it will do much better for them than us because we don't know what we're doing with the titles and thumbnails and stuff. But there was one guy, and he's been doing this for years, he's a bigger channel than us now, but he's been ripping off our content for a long time. And he took our free training and a couple of the probabilities videos we did, used all the talking points throughout his video, but then when it came to the conclusion where he was wrapping things up, then he made a statement that proved that he didn't actually understand what he was talking about. Because he said, because of all these things we've discussed, therefore you should trade with asymmetric risk-reward ratios, because that way you can be wrong more times than you're right and still make a profit. Now, that's right, but it's not really anything to do with probabilities. And so I thought if we go through this video, go through it in as like simple, easy to understand way as possible and make it clear why it's important and what role it needs to play, then when someone inevitably steals or rips off some of this information and repackages it, then at least they'll get it right this time. It's a bit cynical of me, isn't it? Oh well. So this is what it's all based around here. Now this is something I spoke about in the last video as well, but I think this really paints the picture nicely. So let's say that we're playing a coin toss game, and when it lands on heads, you're going to give me £1. Okay, so that's a minus £1 for you. And when it lands on tails, I'm going to give you £2. Okay, and let's say that we've run all of these scientific experiments on the coin to make sure it's fairly weighted, that you don't have to have any doubts about whether it's going to land just on heads or tails. Because at school, when I was a kid, I used to love magic stuff, and I had this 50p that was weighted so it would always land on heads, and I'd make bets in the playground and get money off people. I remember in a French class, I did it with this guy, I'm not going to say it, I was about to say his name, but this Korean guy, and he got so angry he punched me in the head. And that was the end of the 50p game. Although I have to say he had pillow fist, it wasn't too bad. But anyway, let's say that this is the game we're playing. And let's say that it lands on heads 10 times in a row. So you're down £10. Okay, so put it over here. You can think of that as your drawdown. So on the 11th go, do you think that you'll have any issue continuing with the game? Do you think you'll have any problem saying, no, let's flip again? No, you would continue because you know that you've got a good edge here. So there's not really any situation where, as long as you understand that it is fairly weighted and there's no advantage on the actual coin itself, there's no reason that you're not going to continue playing. As long as you have enough money to endure reasonable drawdown, then you'll keep playing until the opponent, or me in this case, is bankrupt and you've got as much money out of the situation as you can. And you won't have trading psychology issues, you won't try and change your strategy or your approach. You just keep flipping the coin, flipping the coin, flipping the coin, letting that edge play out over time. So that means for this scenario to be like one that you're comfortable with, that you'll keep playing, it has to be that you know you have an edge. Okay, so you know you have an edge in this case. I'm going to say it once and once only. Sorry about my handwriting. I know that it's terrible. And the second thing is that you need to have evidence of the edge. Oops. Okay, because if you have evidence of the edge, well, if you have evidence, meaning that you have data showing how this plays out over time, but you don't have an edge, well, then you're not going to want to trade it because you know that if you keep playing that, you're going to lose money. Like, for example, if we knew this was the other way around, you wouldn't want to play anymore. So if you've got evidence and it's showing that you don't have an edge, you're not going to want to play. But if you know that you have an edge, or you think you have an edge, but you've got no evidence of it, then again, you're not going to know whether to play or not, because as soon as you start hitting a losing streak, like when you were down £10, when you had that drawdown, you're not going to know whether that is a sign that you're actually not, you don't have an edge, that you're not as skillful as you thought you were, and that you should stop playing. So you need two things to really feel in control and to keep playing the game. You need to know you have an edge, and you need to have evidence of that edge. So imagine that in trading. If you know you have an edge and you've got evidence of that edge, then most problems disappear. Now, something we'll come on to in a second, but let's think about this in trading terms then. So this is if it's a coin, but I want us to think about if it's with trading. And you're going to see why I believe that the skill of estimating probabilities is the holy grail of trading. Because this calculation you see here is the expectancy calculation. So you have the positive outcome multiplied by the probability of the positive outcome minus the negative outcome multiplied by the probability of the negative outcome. So assuming you that you could just pick out some positive outcomes and negative outcomes, then the real skill here is estimating the probability, not picking out the outcomes, but being able to estimate the probabilities of them. And the more accurate you are at achieving that, estimating the probabilities, the more you're going to be able to develop an edge and be able to have the evidence that you have an edge. Now, imagine this. If you are good at estimating probabilities, okay, so you're not only that you've developed the skill to do it, but you've now tracked through your data and proven that you're accurate with it, just imagine what that would mean for your trading. you wouldn't need necessarily a system or a strategy, at least not one that's telling you when these criteria are met, enter a trade, like a pattern or something like that. You wouldn't need to limit yourself to certain markets or timeframes or activity types or cycles or anything. It would be the case that any market, any asset, it doesn't matter, any market in any situation, as long as you can define the outcomes and you can estimate the probabilities of them, you can determine if there's an opportunity or not. Why? Because you just take all of the information that you gather, plug it into this calculation, and look at the expectancy. If it's positive, you can take the trade. If it's negative, you don't take the trade. It makes a lot of aspects of people's trading completely redundant if you could just master that skill. You know, a lot of people spend their time working on this skill of pattern recognition. They're looking for zones and fair value gaps and chart patterns and all these kinds of things and getting better at spotting these things and thinking that's improving their ability to trade profitably. But instead, the real skill that everyone should be working on is your ability to estimate probabilities more accurately, because if you can do that, you don't need to have these special strategies and stuff like that. Okay? So think about it. All of these problems that people encounter will be solved as a result of improving your probability estimates, or actually just doing it in the first place. So the first thing is that it improves your skill-luck balance. So this is something that people don't really think about that much, but we've talked about in this channel before. If you imagine this continuum between skill and luck, and we can think of all activities, all sports and everything being somewhere on this continuum. So if we think about like chess at the highest levels, I mean, if I'm playing chess against someone, probably a lot of it's going to be luck. But let's say that you enter the World Championships. Not much of it is down to luck. You're mostly here, right? Chess is going to be somewhere along here. Whereas if you're playing roulette and you're not doing like the secret camera that's recording the spin of the wheel so you know what to bet on, but you're just like a normal person, then that's all the way down here at luck. There's no element of skill to it. Then you can think of things like poker, for example. Poker is a mix of luck and skill because it depends on what cards are drawn, but also there is a skill aspect to it. So, I don't know, like you could say maybe it's somewhere like in the middle or like somewhere along here and so on. Now, what you'll find is that with many activities, it can be either more luck or more skill depending on how you approach it and how good you are at it. So let's think about basketball, for example. If you're taking a free throw and you've never played basketball before, how much of it is skill? Probably not much. But if you're looking at, I don't know, LeBron James, I can't think of a better, Steph Curry, we'll go with Steph Curry. If you're looking at him taking free throws, how much of it is skill and how much of it is luck? Okay, it's much more on the skill side. But there'll be elements of the game for the professionals that will be luck. Like, for example, when it bounces awkwardly off the rim and someone gets the rebound, or like that wouldn't have got it otherwise, or opponent slips over, whatever. There's elements of luck there, but a lot of it's to do with skill. So it should be the case that if two teams playing against each other and both are fully motivated, both are fully fit and switched on, then the more skillful team is going to win. I mean, you can consider like plays and tactics and things, but anyway. So it's kind of the case for trading that, beginner traders can be all the way down here, like as if they're playing roulette with luck. And a really good trader who is doing all the right things maybe is over here. There's still some things that you're not going to be able to completely remove, because we can also think of skill and luck as being things that you can control or things that you can't control. Or it can also be things that you have some sort of certainty over and things that you have complete uncertainty with. There's different ways that we can think of this. Like, it doesn't matter how skillful you are, you can't control the markets. So there's always going to be an element where it's kind of out of your control and it's like, okay, whatever happens next happens. Like, who could have imagined that the pandemic would have struck when it did and the markets would have gone completely mad like they did do. So the problem is a lot of traders, without realizing it, are going to be down here on the luck side, but they'll be doing all their analysis, they'll have a strategy and a system, and they will truly believe that what they're doing is skill, but it's not. It's kind of like, trying to play a game of football and following basketball rules. You know, you might be really skilled at basketball. If you play the wrong game, then you're not going to be very skillful at all. You're relying on luck. So same kind of thing. Like most of the analysis approaches people use are just analyzing meaningless things. That is the clustering illusion. It's false causality. So this whole approach of estimating probabilities, what it does is it first of all helps you to see where on this continuum you are. And for some people, it's going to be a really bitter pill to swallow to realize after years and years, you're actually down here, luck. But wherever you are, you can move yourself more this way. To an extent, you'll never be fully on this side, but you can move yourself more this way as a result of what we're going to go through in this video. It stops you unnecessarily losing money because going back to the expectancy calculation, you'll be able to figure out when the situation is negative expectancy and therefore you don't take that trade. Because right now, many of you watching this, most traders in the world are taking trades that have a negative expectancy, meaning over time they'll be losing money on their trades. They shouldn't be taking the trades. You know, just really quickly, I've mentioned this in videos before, so I'll cover this briefly, but your role as a trader is not to try and pick out profitable trades. When you're analyzing a situation, you shouldn't be thinking to yourself, will this trade end up in a profit? Because guess what? You don't fucking know. The whole thing of there are things that are out of your control and things that are in your control. All you can do is estimate the probability of it being a profit. Okay, you can't say this is going to be a profit. You never know with 100% certainty. So what probability is it? Is it 98%, 60, 50, 40? And the thing is that, and this is something people talk about all the time, they'll say, so-and-so trader, like some big name trader, was only right 20% of the time and they still made a profit overall. And this is why you need asymmetric risk returns. That's all nonsense, right? It's not to do with the asymmetric risk returns or not. It's to do with the probabilities. So you could have a situation where you have asymmetric risk returns and the probabilities are against you. So you're expecting with that particular trade, you're going to lose. So for example, let's say that you have 1-to-2 trade where this is the risk, this is the return. But the probabilities of this compared to this one actually is 40% and this is 60%. Now I'm not going to do the calculation, but you can run it through the calculation before. In fact, it's easy anyway. So let's just do it. Okay, so you got 2 times 0.4 minus 1 times 0.6. So we could say that's going to be 0.6. That's going to be 0.8. That minus that equals 0.2. Okay, probably watch this back and be like, hold on, that calculation was massively wrong. And I'll think, how could I have got a calculation that simple so massively wrong? But anyway, what you'll start realizing is that you're not trying to pick out a trade that you think will end in profit. You're trying to pick out the positive expectancy trades, because this one, you've got a 60% chance of losing, which means you're expecting when you open that trade that you're going to lose. And yet it's a trade that over the long run is going to make you money. So stops you unnecessarily losing money by taking negative expectancy trades, not by avoiding losing trades. It improves your decision making because not only is it going to be about when you enter a trade, but also other actions that you take, scaling in, scaling out, moving your stop loss and so on. It should all be based around the probabilities. It makes it easier to improve your trading because you can identify the areas where your trading is weaker. We've talked about in one of the last videos, but we're going to go through it again. And it solves major trading psychology problems. Because think about it, when I said before about the coin toss game, if that was the situation with your trading, you wouldn't feel FOMO and all this sort of stuff. You just keep playing the game, keep going, keep going. You wouldn't hesitate when you're entering the trade because you know if it's positive expectancy, then that's going to make you money over the long run. So all you want to do is keep trading the right way, keep trading, keep trading, keep trading, keep refining your probability estimates so you can figure out where you're getting things wrong and where it's a negative expectancy situation. And just, you know, that becomes the focus of your trading and not all of these issues that hold you all back right now. Things that we discussed in the last video. So again, I go back to the skill of estimating probabilities is the holy grail in trading. And I would like to know if there's something that's more important than it, because I don't think there is. People say all you need is to keep trading simple and you just need good risk management and good trading psychology. But the thing is, if you get the skill of estimating probabilities and you get accurate at it, well, trading psychology goes out the window. It's gone. Bye-bye. It disappears. And the risk management is all solved for you because you base it on the probabilities and the expectancy. All right, once again, who am I ranting at? I don't know. These things bother me. So here on screen, you can see a lot of the common complaints or, pushback that people have about this, like I shouldn't estimate probabilities because it's not possible to estimate probabilities, or you'd just be guessing, or it's unnecessarily complicated, you can only rely on success rates. All of this stuff we're going to be addressing. You see, when people say it's not possible to estimate probabilities, I'm going to show you that one, you're already doing it, and two, it is possible. When it's you'd just be guessing, yeah, to start with, it's more like a guess, but you can improve. It's a skill that's developed. But if you're already doing it and you're relying on that, you're already guessing, but you don't realize it. Unnecessarily complicated or difficult, this is the thing about trading. You don't do things for the sake of it. Like, we don't do things that are difficult or complicated because, oh, it's fun to challenge ourselves. We do it because that's what's going to improve you. And if you think about sports, I think about football a lot. A lot, just in general. But when I think about football, I think about you got someone like Cristiano Ronaldo and you've got someone like, I don't know, Kieran Richardson. Both players that have some talent. One that didn't give a shit, one that was willing to do every extra little thing they could to gain any extra advantage. And you look at the trajectory of their careers and how they're so vastly different. And one of them would be like, it's fine, I'm skillful, I don't need to train that hard. And the other would be like, I'm going to figure out every final little edge that I can get. And there's a quote from Arsene Wenger, who is a legend, and I won't hear otherwise, who said that the sort of the big difference between any talented players was how hard they trained and what they focused on in trading. That dictated the trajectory of their careers and not their initial talent. And it's the same in trading. Like, it's not a surprise to me that 95% of the market fails because people are not willing to do the complicated or difficult things. They just want to do what's simple. You see how many of the videos online that get millions of views are like simple approach to trading. Well, if you're looking for simple, I mean, if it was possible to just have things simple and that's all you needed, and well, first of all, if it was possible to just keep things simple and to succeed, more people would be doing so. Then people's argument would be, well, no, because you need good trading psychology and that's tough to master and good risk management and blah, blah, blah. Well, if you have a simple approach and you can backtest and prove to yourself, like you have the evidence that that's giving you an edge, this really simple approach, it's just like the coin toss game. All of the trading psychology goes out the window. But the fact is, either with a simple approach, you don't have an edge, or you don't have evidence of the edge. So anyway, you can only rely on success rates. We'll cover why that's not the case. And you won't know if you're correct. We'll cover why that's not the case. I mean, you won't know you're correct on each individual trade because obviously if you're estimating a probability, well, you only have one outcome. So I can't say something's got a 60% chance of happening, then it happens. And I say, oh, I was wrong because it happened 100%. We have to take a group of data and find the average of it. Or people just say, I'll just stick with this that I'm doing. I'll just stick with focusing on risk management. People in this industry are so reluctant to take on new information that conflicts with what they've already learned and spent a lot of time investing time and effort into learning. If you really want to get good at this, there's that quote by Paul Tudor Jones that you need to, have an indefatigable thirst for knowledge or something, he says. That's what you really need. To this day, I love learning new things about trading. And you might think, oh, the fact you've gone on about probabilities so much recently is because you've just learned about it. And no, it's not the case. We have videos from 7 or 8 years ago where I was talking about probabilities, calibration, all of that. But what I realized in more recent years, as you dig into the research in various different areas that affect traders, and when you work with traders, which I do, I've helped hundreds, if not thousands of traders now, and worked with some really experienced traders, you start to notice that, hold on, almost every problem that people encounter, almost everything that holds back someone from actually succeeding at this would be solved by probabilities. And so that's why it's been elevated over time, to being the holy grail for me. And that's why I'm focusing on it so much more now, because I'm not sure if I'll do videos on YouTube beyond the end of this year. And if I don't, I want to make sure that I leave this industry with everyone understanding and appreciating probabilities. And if I came back to YouTube 5 years later and saw everyone obsessed with measuring their probabilities and calibrating and getting better at it, I'd be like, thank God. And if that was the case and everyone was learning that and actually putting the effort into that, you'd see the percentage of losing accounts with brokers would drop significantly. There'd be such a bigger percentage of traders that are actually succeeding. Now, with all of those points that we've just been through, the really important thing that I want you to take on board here is that you are already doing it. This isn't something new. It's just taking something you're already doing and making it so much better so you can rely on it. And you're doing it in your everyday life and you're doing it in your trading. So let's think about in your everyday life. This chart is one of the most depressing charts you'll ever see in your life. You might be able to guess what it is from what's over here. This is number of days each year in the UK that it rains. If you're living in London like me and it's currently, well, it's 6 degrees outside at the moment. This morning it was -3, which was just horrific. But at least it's not raining. So you can see that on the average year, it's more or less, it's around 150 days. The one on the far right here, that was last year and it was a bit more than 150 days. So if we look at this, we can say 150 rainy days a year. We count that as failure. That means if there's 365 days in the year, which there isn't always, then there's 215 non-rainy days and we're going to call that a success. So that gives us a success rate of 59%. We can say that 41% of the time it rains. Oops, dropped the pen there. So when you look out your window and you're planning what to do for a particular day, let's say it's, middle of July. Do you think to yourself, oh, maybe I need to take an umbrella today because there's a 41% chance of rain? No, of course you don't. You look at the sky, clear sky, it's sunny, you think, not going to rain today. Or maybe you look at the app, the weather app, and usually they show you the chance of rain and it will be a different percentage each day. Do you think that they're looking at this and saying, okay, it's going to be 41% chance of rain? No, because it's going to be different on a February to a day in December to the day in July to when the sky is covered in clouds to when it's not, and so on and so on. It depends on the context. So we're using probabilities to make these decisions in our everyday life. And it's not about, in this case, we can call this success rate. It's not about success rate, it's about probability each day. We're taking on board context about the situation to make those judgments. And there are many other ways that we use probabilities in our everyday life. Like when you see a car coming in a distance and you're about to cross the road and you're deciding, can I make it across the road before the car hits me? You're using probabilities. When you're deciding whether to take an umbrella when you're looking out at the weather, then you're using probabilities. When you're deciding what time should I leave for work to avoid the traffic, you're using probabilities. There are so many ways that you're using probabilities in your everyday life. And surprisingly, we're actually quite accurate at a lot of these situations. And we'll discuss that later, why that's the case, how we get more accurate at it when we're not accurate. But more importantly for us, you're also using it already for your trading. So here we just have a random chart. I think this was Aussie dollar, New Zealand dollar or something. So let's say that we go back over the last 10 years and I'm going to open 1,000 trades. Like I'm going to go on a simulator and I'm just going to spend the weekend opening 1,000 random trades. And what I'm going to do is I'm going to open trades that are one-to-one risk reward. Okay, so risking 1 to make 1. I'm going to open them at random points on the chart. I'm going to flip a coin to decide whether I'm going long or short. If it's heads, I'm going long. If it's tails, I'm going short. So after 1,000 trades, what do you expect my results to look like? Let's say that I'm not just using like one chart like this because obviously it could be influenced by trends, but we're going across 10 years so that there are different trends, different market activity and so on. I'm going to open one-to-one trades, flipping a coin to go long or short. What do you think? Well, we can imagine that I'm going to lose trades 50% of the time and profit 50% of the time, more or less. Like after 1,000 trades, a large enough sample size, it should fall to this. I've got no advantage because I'm flipping the coin. So it's just about distances. If it's like that I'm risking 30 pips to make a profit of 30 pips, for example. Okay, it should be about 50-50, but I'm obviously going to lose money because of transaction costs, like the spreads and so on. But I think in a simulator, you can maybe even remove all that. So if I removed everything, you'd say it's more or less about 50%. Would you take those trades? Would that be a good strategy to follow? Of course not. Stupid. It would be a stupid strategy to follow. What if instead I did 1, 2, 3? So in this case, I'm following the advice of what people say when they say trading is a game of probabilities, therefore you should do asymmetric risk return and you could be wrong more times than you're right and still make a profit. Well, what do we think if I'm flipping a coin to decide whether to go long or short and I'm just doing, let's say, 30 pips against 90 pips, what are the results going to be? What do you think they're going to be? Well, once again, it's going to be around break even because there's no advantage here. So it's going to hit this 3 times as often, it's going to hit this 3 times as often as it hits this, which means it's going to hit this 75% of the time, and it's going to hit this 25% of the time. Okay, so we can call these, like I've spoken about in previous videos, our base rates. So our base rate is essentially, if we had no edge in the market, if we're flipping a coin to go long or short, and doing it over a long enough period of time so that there's no advantage of like trends and stuff, what would the probabilities be? Those are our base rates. It's funny, in one of the last videos when I talked about probabilities, someone was complaining, there were actually two people that called me snake oil, and one said that this approach sounds like snake oil, and I was like, hold on a second. So I'm giving you something where you can measure your edge and it's objective, and you're saying it's snake oil, compared to all of these idiots out there who are using vague entry and exit criteria, keeping things vague intentionally so you can't test the approach, giving you no means to test their approach, and somehow the one that's being more precise and actually testing it and giving you an approach that you can use the scientific method with is snake oil. And then the other person said, this sounds, it is snake oil because your base rates don't exist, they're just made up. It's just, this is basic maths, okay? This is just basic maths. There's nothing else to this. I mean, you can just go and test it for yourself if you don't believe it. The only thing that's made up here is that I'm calling it the base rate, but you'll understand why I call it the base rate when we get onto something a bit later. Okay, so you wouldn't take any of these trades, but for those of you who have been trading up until the point you've actually taken trades, well, you've taken trades that are either a 1-to-1 or a 1-to-3 or some other scenario that with a base rate would be giving you break even, but for some reason you've thought you've had some sort of advantage. So let's say, for example, that, I don't know, I've got like a setup where I'm going short here, and I'm going to put a stop loss up here, which is my 1, and I'm going to have a take profit down here, that's 3. Okay, 3-to-1 trade like this. If I'm taking this trade, I'm implicitly or indirectly making a statement that I think the probabilities are better than these. So I think that the chance of hitting the stop loss, the 1, is less than 75%, and therefore the chance of hitting the 3, the profit, is more than 25%. Okay, so I've made an estimate on probabilities there. I've said the probabilities are better than these. But if I'm not defining it, if I'm not measuring this or like actually defining what the probability is, then I can't get better at it. I can't tell if I'm accurate. But you, when you're taking trades, you're indirectly making a statement about the probabilities, saying that they are better than base rate, and that's why you're taking the trade. And how do we know that? Because if all you were getting was the base rate probabilities, you wouldn't be taking the trade. And if your probabilities were worse than base rate, you also wouldn't be taking the trade because you know you'd be losing money overall. So the fact you're taking the trades means that you are making an estimate of the probabilities. Okay, so both in your trading and in your everyday life, you're already estimating probabilities. You just are maybe not consciously aware that you're doing it. Okay, so the next thing that people say, because now I've said, okay, we need to be more specific about the probabilities that we're estimating so that we can measure how accurate we are and improve. And people say, well, you can't do that. It's impossible. I can't pick out, like, how can I say that this is 64% or something like that? And I want to show you that it is possible. Okay, so let's say that you have a trade. Oops, wrong thing here. And you can test this next time you're taking a trade. I encourage you to, because this will be the first step towards actually estimating the probabilities. So let's say that this lovely uptrend like this, and you think that this is either the terminal point or at the very least you're going to get one leg of the wave here. So you're going to enter a trade here. And let's say, so we can keep it in line with what we've just been going through, that this is going to be 3-to-1. Okay, so your stop loss is up here and that's 1, and your take profit or like initial target is down here and that's 3. Okay, so 1-to-3, oops, risk reward. Now, we know that the base rate in this situation is going to be 25% and 75%. So I'll say to you, what percentage chance do you think there is of a profit? And what we want to get to is the point where we can do something called the equivalent bet test. Oops, I don't know what's going on with my writing there. Equivalent bet test. Okay, it's very difficult to write and talk at the same time. Obviously, I can't multitask. So This is something that I believe his name was Doug Hubbard talks about in his books. He also does a lot of the calibration workshops and stuff with people, so he's like a leading expert on this. But essentially what we want to do is, like, let's say that you think the probability is 30%. Okay, so there's a 30% chance of a profit, therefore it will have positive expectancy. Well, then what I can do is say, okay, so we are going to, very bad. Let's say that this part that's shaded is 30%. And I say that if this lands here, you're going to make 3. And if it lands here, you're going to pay me 1. Okay? And by the way, if you couldn't tell by my amazing drawing here, this is like a spinny wheel, like the Wheel of Fortune. So this little white triangle is, if it lands, like if the wheel stops and it's in the shaded area, you're going to make 3. And if it's in the non-shaded area, you're going to pay me 1. So if I say to you now, which one do you want to go for? So we're going to be betting real money, like significant money, life-changing money. Do you want to go for this trade, or do you want to go for this wheel? And let's say you reply, let's go for the wheel. And I say, why? And you say, well, because I think there's probably a best chance of getting the 3. Well, in that case, you've been overconfident with your probability, because you don't actually think it's 30%, because if you thought it was 30%, you wouldn't be preferring to go for the wheel that is 30%. On the other hand, if you say to me, I will want to go for the trade, then you've been underconfident with your probability, because you don't think it's 30%, you think it's better than that, otherwise you would go for the wheel. So what you want to do is find the percentage where they're equivalent, where it's an equivalent bet, where you don't care whether you go for the wheel or whether you go for the trade. Okay? Now, a lot of people initially will say, well, I have no fucking idea. It could be 30%, it could be 50% for all I know. So it's just guessing. And I would reply, no, it's not guessing. I'm having a conversation with someone in my head here. It's not guessing, because we can start with extremes. So, for example, do you think that there's a 100% chance, so let's get rid of this, do you think there's a 100% chance of the profit? You'll say, no, that's absurd. Do you think there's a 90% chance? No, that's absurd. And so on, until you sort of go from the 100% on this side and you work your way down until it's somewhere here, like 40% or something like that. Okay? Then we go from the other end. Do you think there's a 0% chance? No, that's absurd. 20, 30, and so on. And you end up with this window where it could be between these values. Let's say, for example, that it's going to be between 23% and 40%. Okay, great. Now we've got our margin of error. So we can still track this, we can still take the trade, or we can still run this through the positive expectancy calculation, but we can just say, okay, we're going to run this side, and if that happens, okay, we'll end up with negative expectancy, but the chance of that happening compared to the rest, like there's a lot more that could end up with a profitable outcome, because anything above 25% is going to be profitable, so maybe we accept that margin of error there and take the trade. But at least we can start tracking something, and over time we'll get better and better. Now this, some of you would already know what this is called, and therefore you will get why I said what I said, but this is called the absurdity test. And it's basically, a lot of people, without the S, a lot of people will say, I don't know. But people know more than they think they know. It's just that you have to you can start off by ruling out what you know to not be true, or you know is absurd, and end up with something that's more reasonable. Then from there you can say, okay, what range would we have that will give you a 95% confidence interval or something like that. And there are ways we could test that, but we won't get into that for now. I just want you to understand that there are ways that we could get you to already nail down a probability, okay? And that means, if this is the case, somewhere deep in your subconscious, you have a probability, and that's how you're making this estimate in the markets. So let's say you end up with this being 28%. Great, now we can track that and see over time how accurate you are. Perfect, then you can start improving. But there's a problem, okay? That if you're already doing these probability estimates with your trades, the issue is that extensive studies have shown that people are not naturally calibrated with their estimations. And here are a bunch of studies, and there are many more that have shown this. Just in case you want to go and look it up, if you think I'm just making things up, go and check it out. And what's been found is that people are usually biased towards either overconfidence or underconfidence. So remember in that last example when I said about the equivalent bet test, that if you were preferring to go for the spinny wheel, you've been overconfident with your estimations, and vice versa, being underconfident. So the funny thing is that people are biased towards one or the other, but not like in individual things. It's not like, okay, in trading I'm always overconfident and this I'm underconfident. It's like a systemic thing. It's that you're usually overconfident in most things or usually underconfident in most things. And so if we are not measuring what we're doing and calibrating, then you could be overestimating or underestimating on these trades, because studies have shown that you naturally will be. But the good news is that you can improve on this. So the first thing over here, we've got, I think this guy's like a famous Las Vegas odds maker. So there are people like Philip Tetlock, like Doug Hubbard, who I spoke about a minute ago, who run huge studies on forecasting. And for Philip Tetlock, it's the super forecasters with his Good Judgment project. With Doug Hubbard, it's about like taking groups of people and taking them through calibration training. I think he gets paid by companies. And what he states is that there are certain groups of people who are naturally better calibrated than others. For example, bookmakers, the people who set odds for like sports betting and stuff like that, the people who set those odds are naturally, or not naturally, but in these groups that they go through this calibration training, right at the start, they're better calibrated than CEOs. And others that deal with probabilities in their job are better calibrated even when asked questions that are unrelated to their job. So it's not that they're better calibrated just in, bookmaking. It's that they're better calibrated in general. So they found that once you go through calibration training, it doesn't just improve the one area that you focused on for that, it's going to improve your ability to estimate probabilities across the board in anything. So when you improve your ability to estimate probabilities in trading, it's going to impact and improve other aspects of your life as well. And you'll see it. Once you go through all this stuff, you'll see it in everyday life. Like someone, it's funny, one of our members sent me a message saying, and he'll probably watch this and know it was him, but he was, I don't even know if I should repeat this. I think he said he was sitting in a sauna going through the probabilities of someone's towel dropping or something. Don't use probabilities in that way, because while you're sitting there staring and trying to figure out and go through the calculations, they'll probably be calling security on you saying he's staring at my chest. We'll leave it at that. So that's the first thing, that it is possible. It's been shown that you can improve through calibration training, and it will improve all aspects of probability estimates, not just trading. And then this one, this is fascinating. So this is from a study that was done by John Coates, the former trader, now neuroscientist, does a lot of the studies on trading. And they were studying other aspects of trading, but through that, indirectly, they were gathering this data and indirectly made or came to another conclusion. So we can see here the Sharpe ratios of all traders, then beginners and experienced. And what they realized is that over time, traders improve their Sharpe ratio. So a Sharpe ratio is a measure of how good you are at trading. I mean, I think there are better ways, but it's an industry standard. So what John Coates deduced from this, or like his conclusion, was that this shows that it's possible to develop intuition in the markets. Because you could be using the same strategy and whatever, but your Sharpe ratio improves over your career. So something has improved. So I believe, this is not from John Coates, this is what I have sort of taken from this, is that what is intuition? Well, in the case of the markets, I'd say intuition is implicit learning. So there's implicit knowledge and explicit knowledge. And obviously the implicit knowledge and explicit knowledge becomes knowledge by implicit or explicit learning. Explicit knowledge is what most of you watching this have for trading right now, which is rules, techniques, things that you could explain out loud about your trading. Oh, this is how you read a so-and-so indicator. This is how I look for a nonsense head and shoulders pattern. Sorry, I have to get these digs in there where I can. It makes me feel good about myself. It's just, simple things in life. Sad little life we live. Then the implicit knowledge is the stuff that you can't quite explain. And actually, in the research, it's defined, this should be a quote because it's actually quoted from the research, is defined as being a deep understanding of the statistical structure of event sequences. Now, maybe I'm stretching a little bit here, but how else could we describe this? Would it not be that it's about understanding or being able to estimate the probabilities of situations? I think so. So I think that John Coates' study shows that since most people are estimating, like when we take a trade, we're estimating the probabilities. Okay, we're saying it's better than base rate, and the more experience you get, the better you get at doing that. So they're developing their ability. But I bet you if they measured it and did the calibration to improve it, they'd develop their Sharpe ratio even quicker. And you're going to do that, and you're going to prove me right, because you're going to get amazing at trading, and you're going to say it was all because I started to track my probabilities and estimate them and calibrate. Now, this whole thing of implicit and explicit learning, I've seen it mentioned, we talked about it extensively in our program, and I've seen it mentioned a few times in some trading videos, but there are ways that unless you go through the research, there are things that I think people are missing. And there are some really, really fascinating studies on this that prove just how important it is to develop implicit knowledge. And you are developing it, you will be developing it with your trading. But you see, the more that you focus on the explicit side, which everything on social media that you see where it's like, this is how you trade the fair value gap, and you're doing the fair value gap wrong because you should be looking for this thing, and all of these little rules, it's just like stacking rules on top of rules and pattern recognition and stuff. All of this is just making you rely more and more on explicit knowledge, and you're never developing the implicit knowledge, or not as much as you could, because of how much you're trying to look for things. Like you're just playing an adult version of Where's Wally or Where's Waldo, rather than actually developing a skill. But there's studies done on, it's called an SRT, so serial reaction time test. And essentially what they have is like 4 lights like this, and each light has a corresponding button. And when it lights up, you press the button and they measure your reaction time. So when it's a sequence, like it was like duh, 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 every time, then you'd know, so your reaction time's quicker. And when it's random completely, your reaction time is slower. Then they do interesting things, like they do a sequence that people can't consciously pick up on. So if it's a sequence and I ask you to explain a sequence, you probably haven't even realized it's a sequence. It's quite a complex one, but subconsciously you've picked up on it and it's improved your reaction time. Then they have complex sequences which are muddied by randomness. So definitely someone can't consciously detect it, and they still see improved reaction time. And it's showing how you, through implicit learning, can pick up on these patterns even in amongst randomness, which relates to the markets, because in the markets, at least with what we believe with the Duomo market theory, there are some movements which are predictable, and there are some movements that are random. And this is when the markets are in steady state, so when it's not reacting to repricing based on information. So there's a mix of random and deterministic, and we can pick up on the deterministic parts even amongst the randomness because of what we're seeing in the SRT test. Anyway, that's a whole topic for another time. So how do we improve the skill? How do we develop it? So there are 10 points here, and these have been taken from a mix of the sort of literature and the groups, the decision psychologists that focus on this area and do the studies. So it's the points that they've put together. I've sort of combined things from different places, the ones that I think apply to trading, and also from my own experience and from working with traders to know which ones are actually applicable. So we're going to go through each of these one by one. Some of them we won't need to go through that in much detail, so it won't take too long, hopefully. And I just want to point out just down here, say, in the description box, there's a link to our free training, and you also find links to other free resources that we have. Now, the free training, I'm actually recording a new version of it soon, a completely different training, but the one that's on there right now at the time of filming this, there are similarities to what we're going through in this session. I'd still recommend watching it all, but sign up anyway, because after that training, I also send you lots more training for different areas of your trading, stuff that's deeply researched, evidence-based, extensively tested, based on my experience. And the stuff that we give away for free, I know this is a bit of a cliche, but we make sure it's much better than people's paid or free stuff, because we genuinely want you to get value from the things you're learning. So it's not like a glorified sales process or something. So sign up for the training anyway, even though it's going through similar things, because that way I can send you any new free trainings that I put together, resources and stuff. You'll get all of them, and there's a lot that you're going to get. So go and do that. I said that I was only going to ask you one thing, which is to watch all of this. and if you have questions to ask me and stuff, but I'm asking you another thing, which is to sign up. Okay, I just had to stop the recording and start it again because I'm absolutely petrified of some issue going on and me losing all of this explanation. Okay, so the first point is that we don't want to use vague language, we want to be specific. And when we say specific, that means using a number for the percentages. So where's my pen gone? We want to use a number, meaning 75%. Oh, 75%. One of our members complained about the way I do my fives. It's just how we were taught at school. You do this bit, then you put the hat on top. That's how we were taught. It's like 75%, 76%. If you want to get really, really precise, you could do 76.2% or something. And you might say, that's crazy. Well, you don't need to get that granular. But actually, there are studies that have been done on this again, and they've shown through super forecasters, so people who are really calibrated with their probability estimates, that actually the smaller the differences in probabilities, that actually has an impact on the accuracy, the level of accuracy. I'm not explaining it very well just off the top of my head like this, but well, if you really want to have the information, then I'll give it to you in the comments. Just let me know. So this, what you can see on screen here, is a study that was done at the CIA with intelligence analysts. And what they were studying is, well, are these, what they call words of estimative probability. So what they found was that, you know, at the CIA, they're analyzing complex information and then having to come up with probabilities of different scenarios potentially playing out. And these scenarios can have a huge impact on the world. It can have an impact on decisions about whether to go to war or things like that. And so they started to realize that when people are using words like that's probably going to happen or it's likely to happen, people are interpreting them differently. And if people are interpreting them differently, then that means that they might come to the wrong conclusion. So before they switched to doing numbers, they did this study and they asked people, okay, with these words, what percentage probability would you put this as? And look at the wide ranges between each of these words. But you know what I think is really worrying is that these intelligence analysts, obviously they're putting together the intelligence, but they should be intelligent as well. And I really wonder what absolute nut jobs are working at the CIA who think that there's 100% probability when someone has put improbable, or little chance means 90%. Are they absolutely insane? Or look at the other end, almost certain. What's that, about 3%? Get these people out of there. These people are the reasons that governments make the disastrous decisions that they do sometimes. Get them out of there. Anyway, this shows you, like with your own trading, if you say, oh, it's fairly likely it'll be a profit, but that's not good enough because one, you can't measure that. Two, over time, you will adjust those probabilities to be something that's more favorable for you. Again, that's something that's been studied where people assess how likely they think something is. I think it was done, there was a study in like the 70s or something on some sort of event involving Russia. We mentioned it in the program, but I can't remember exactly what it was. But they saw that after the event, people's reflection of what they thought, how likely they thought it was, it becomes more favorable. So if an event did happen, then the probability percentage increases from like the word that they stated. And if it doesn't happen, it decreases. And you will do the same because we're all human and we're all susceptible to these things because we like to be right. And our brain has this narrative machine that creates narratives that makes us right and connects the world around us and so on and so on. But it's not helpful for your trading. You need to overcome those silly meat robot tendencies. And it's also like, not only is it that you can't measure things properly, but also when you take a trade today compared to 6 months from now, and both of them were likely to be a profit, we'll move that then, you're going to, in your mind, it could be a completely different probability. But we need to be specific about these things. Otherwise, how can we improve? How can we know that what we're doing is the right thing? So don't use vague language, be specific. You need to start using numbers, even if you start off with broad numbers and get more and more granular as you move on. So starting off with the 10s, moving it to the 5s, then get into the 1s. And then if you want to be a complete oddball and start doing a 0.002%, then up to you. The next thing is that you need training on forecasting and estimating probabilities. So funnily enough, what we're going through right now is training on forecasting and estimating probabilities. So Philip Tetlock and the Good Judgment Project found that just from one training session on estimating probabilities, people were more accurate with estimating probabilities. Because, you know, it's not just about developing the skill of estimating probabilities. Obviously, that is going to have a big impact on how accurate you are. It's also about the techniques that you use, the frameworks to actually... So the way that some of these techniques and frameworks work, it's not that they then dramatically improve... how to word this in a way that makes sense. They're basically helping you to think in the right way, to get the information that you already have in mind and apply it in the right way for the probability estimate. That's what they're for. It's not that they're going to actually do it for you. They're helping you to use your brain in the right way, which you wouldn't already be doing, or at least not to this extent. So what you can see on screen here is Bayes' theorem, or Bayes' rule. Bayes' rule. And I know that if you're not used to formulas and stuff, then this can look a bit complicated. And, you know, it's probably more complicated than we need it to be. We can keep things really simple. And essentially what we're going to be looking at is we are going to start with what we call a base rate, which is why now you'll figure out, that's why I call those probabilities, if you have no edge, the base rate. So you start off with a base rate. It's also known as a prior. And then what you're effectively doing is taking all the information that you know about the situation, okay? So if you think the base rate is that there's no edge, then you're taking all the information that you know, like the variables, and ending up with what we call a posterior. So you have a prior and a posterior, but we'll just say base rate, and what we call it is just adjusted probability. Okay, so that's essentially what you're doing. You're taking a logical starting point and ending up with something that's adjusted with the variables. If you like behavioral psychology and Daniel Kahneman, I think he would refer to this as the inside view. Then you apply this, the outside view, and then you end up with like the final probability. So this is not like, for some reason, when we talk about these probability estimates and going through this process with trading, people think it's insane. Like, how can you do that in the markets? You can't predict what's going to happen in the markets, blah, blah, blah. But I mean, I've just told you about the CIA, who are analyzing really complex situations with lots of moving parts and coming up with probability estimates for different scenarios. In scenario planning, in business and different things, where you have these decision trees, you come up with probabilities of the different things happening. It's how we should be applying things in the market and how the very best traders would be. And if you want to be lazy, then you won't do it. But if you want to be accurate and better at trading, you will do it. And so just to give you an example, if we think about weather, so we talked about earlier that depressing chart of how many days in the UK it rained. Now, we saw that there was a success rate of 59%, so 41% of the time it rained. But when you look at the weather app and it tells you the percentage chance of rain, it's not just applying those percentages. That would be ridiculous. Likewise, when you're looking at your trading, with every trade, you shouldn't just be applying your success rate. Why? Because the context matters. And the context is going to be different in each situation, and that's going to change the probabilities. So here we've got two screenshots, one from the US Weather Organization and one from the UK Weather Organization, whatever the hell they're called. And they're talking about how they forecast the weather in this complex, constantly changing situation. And on the UK side, they say there are 3 important stages: knowing what the weather is doing now, calculating how this will change in the future, and then using their expertise to refine the details. So I've highlighted a few things. This says, in order to know what the weather will do in the future, we first need to know accurately what it's doing now. Now, anyone who's a member of the Duomo Trader Development Program, I hope you're having a light bulb moment and realizing this relates to what we talk about as the phases of a trading system. Okay, so these are called observations, what it's currently doing now. Then they have supercomputers, which use these observations as starting conditions, base rate, for very complex equations that can predict where the weather will move and how it will evolve as time goes on. Then they work around the clock to check the forecast, see if it's going to plan. If it's not, they'll amend any forecast going out to customers. So what they're essentially doing is, as information comes to light, they're adjusting this. So their adjusted probability, or their posterior, becomes their prior or their base rate and gets adjusted as they go along. So it's like a constant tweaking of things. And like they give an example, if the temperature is slightly lower than expected, that could mean the difference of having frost at the end of the night or not. So it changes what's anticipated. Or on the US side, they say weather forecasts are made by collecting data about the current state of the atmosphere, using an understanding of atmospheric processes to predict how that atmosphere will evolve. Before any forecast can be made, a meteorologist must first understand what the current weather conditions are and what's producing them. That's important. What is producing them? When all this data review and analysis is completed over time, meteorologists are provided the means to track the evolution of fronts, jets, cyclones, and anticyclones and use this information for pattern recognition. Okay, so let me just explain what our members would understand. When I talk about the phases of our trading system, we talk about first understanding what's happened in the past, interpreting the current situation in light of understanding what's happened in the past, and then anticipating what may happen in the future. It goes in that order. You have to understand the past to be able to interpret the current situation, to be able to anticipate the future, because it's a sequence of cause effects. And it's not enough to know what is happening now. It's also, you need to know the dynamics of that. What's causing what's happening now? What's caused it? So that's what we go through in our system. And we end up with primary analysis, where we're looking at what's happened in the past, secondary analysis, where we're looking at potential outcomes and estimating probabilities, and that leads us to our entry. So this is what they're doing with the weather. It's all about context. They're gathering information about the context to make predictions about the future. And that's exactly what we do in the markets. So this is dollar franc. Okay, I made a stupid mistake here. So I'm filming this a little bit later on in the video when we've got onto another example, and I've realized it's the next example is the trade on dollar franc that I took. This, what you can see here, is I think the same chart as before. It's the Aussie dollar, New Zealand dollar. So everything I'm saying about taking the trade, just ignore that and just make it like that's a hypothetical trade. And later I'll show you the trade that I took, which it looks very similar actually, and that's why I got confused. But yeah, it's not a trade that I took, it's a hypothetical one. And I took a trade on dollar franc. Well, I pointed out the entry on one of my live stream trading sessions. The entry was going to be at the close of that day, and at the close of that day we got the exact what we were looking for, and I entered the trade. So I entered the trade long here, okay? So what do we need to be able to plug this into our expectancy calculation to figure out whether this could be a trade or not? We need to know the potential outcomes and then estimate the probabilities of them. So I'm gonna just cut a long story short with the potential outcomes and say that in this case, the potential outcomes, it was going to be about here to about here. And it was more or less like a 4 or 5 to 1, okay? And if you need a method of trading that allows you to estimate outcomes in a meaningful way, because technically the price at any point could do anything, right? It can move up 5 ticks, then down 3, and then up another 2. And you need to know where the meaningful outcomes are. And a lot of methods of trading don't have that. They make it vague, like, oh, whenever this pattern comes up, just enter as a 10 to 1. But that's not taken into account the context. Your outcomes have to be based on the context. And since we know prices move in the markets from this relationship of volume and liquidity, and changes in price movements will happen when that balance between the two changes, then we can say that an end of an outcome is likely to be at a point where we'd expect a shift in activity, a change in that balance in some way. And that's what we try to identify with the way that I trade, at least. And I think that's how we should be trading. Everyone should be trading that. Well, I mean, if you're using technical analysis, that should be the focus. So your potential outcome shouldn't be arbitrary. They should be based on something that then is measurable in some way, or is like a defined point that gives you a way of estimating the probabilities. Like if I dropped someone in the middle of London and I said, what do you think the probability is of them ending up in a location in West London compared to East London? This is such a random analogy, but it was from one of our free training things a while ago. And I said, okay, well, what do you think the probability is of one or the other? Well, you said, I don't know, how long is a piece of string? Like what location in East or West London? Like how far? Because if one is like 10 miles away and the other's 2 miles away, it's more likely they're going to end up at the one 2 miles away. Anyway, sorry, the getting sidetracked, but I feel these things are important to explain. So I ended up with this. Let's say that it was a 4 to 1 to make it easy for the calculations here. Okay, so first of all, I've defined the outcomes. So we have 1 to 4, which means that now when I go to the probability estimates, I know that there's a base rate here of 20% here and 80% here. Why? Because it's likely to hit this 4 times as often as this, so that's 80-20. Now, that is the start of the sort of version of Bayes' rule that we use, the prior, and now I can take in all of the information from the situation. So this hadn't happened yet, okay? So we're just down here. So I can look at, for example, how we look at it. I'm looking at 3 broad areas: the structure, the significant levels of path resistance, then the microstructure, which can include like order flow, that kind of thing. So we're looking at volume, the shorter term trends and momentum, that kind of thing. And I can break down all of these individual aspects and adjust the base rate probabilities based on that information. Some adjustments up, some adjustments down. Now, the only way that it's possible to do this is if you actually have a way to differentiate and define each of the aspects. And we'll get onto that in a second. So like a price move, like how do you define and differentiate? Because not all price moves are the same. So we'll cover that in more detail in a second. But basically, by making these adjustments, I could end up with the probabilities that I can put in the expectancy calculation, and I can tell, is it a trade, yes or no? Then I can use the probabilities or the expectancy calculation to decide how much to risk, and then I can take the trade, which I did do. And it ends up being a nice profitable trade, something like between 4 and 5% profit. Lovely. And in a way that can be measured, and we can see over time how accurate I am with it. So this is the process we go through. But there are ways to improve. And one way is to get more accurate base rates. So if we're starting off with a base rate that's just based on if you didn't have an edge, well, what if there are particular scenarios where you know that the base rate can be slightly different? For example, if you're with trend, counter trend, maybe the base rate is slightly different for each of those. Like you can see that, okay, from tens of thousands of trades that I've taken, or that data that I've gathered, that when it's with the trend, instead of the original base rate I had, it's actually a slice adjustment of 3 right off the bat. Okay, that's my base rate then. Or maybe if you believe in the chart patterns and stuff like that, maybe it's with head and shoulders or some other nonsense that there's a different base rate. You get the idea. There could be different types of base rates. Okay, so for some reason there was a problem with the original recording for this section, so I'm having to re-record it so you understand if it sounds a little bit different. But this research is really fascinating. So this was done in the 1990s by a guy called Joshua Tenenbaum and his team. He was a professor of cognitive science at MIT, and he was doing this huge research project to understand the casual ways that people make predictions in their everyday life. And so he got like groups of students and asked them to make predictions about things such as people's lifespans, movie run times, poem length, how long it takes to bake a cake, all these sorts of things, like things that you maybe wouldn't necessarily know off the top of your head, but you could hazard a guess at. And so in this top section, we can see what the actual distributions were, the empirical distributions of these different things. And in the bottom section here, these are the results of people's predictions. And shockingly, they were incredibly accurate on average. So the distributions of people's answers when they were asked to predict these things were very similar to the actual distributions. So we've got different distribution types here, different distribution shapes, if you want to think of it that way. And the distribution of people's answers followed a similar distribution shape, whether it was, like a balanced distribution, power law distribution. You can kind of see a description of it down here. And what they figured out is that it seems that the way we make predictions is by using something that they called Bayesian cognition. And so if we think about Bayes' rule that we went through a moment ago, what we're essentially doing is going through that in our minds. And the reason they call it Bayesian cognition is because if you were going to use a computer to come up with these same predictions, then that computer would have to go through some sort of variation of Bayes' rule. And that's essentially what we're doing. We're taking some sort of reference point initially, so a prior, and then we're making adjustments based on information that we have about the situation. So for example, this is an example that was given in a book that I was reading about this study. If you are talking to one of your male friends and they say that they're going out for dinner that night, then you might think, well, majority of their friends are male, so there's a high probability that they're going out for dinner with another man. But if they point out that, oh, I'm going out for dinner with someone from work, and you know that most of the people on their team at work are female, then you would adjust the probabilities based on that. So it's, without even thinking about it, we're making these adjustments based on the information that we have. We have an initial base rate and then we make these adjustments. Now, the thing that's interesting with this study for this point number 3 of getting more accurate base rates is that some of the questions, the people answering on average got the right distribution, such as the one about pharaohs. So this distribution here is what they had in their answers. So to be more specific, the actual question they were asked here was something along the lines of, if an Egyptian pharaoh has been in power for 11 years, how much longer will they rule for? And so the distribution of their answers ended up being correct, which meant that they were making the right adjustments based on the information they have, that he's been in power for 11 years. But actually, although the distribution was correct, the age overall was wrong. They were predicting that the pharaoh would be much older than what the real distribution was. And the reason for that is that they were using the wrong base rate. They were basing their answer on their knowledge of European kings and queens, or more modern kings and queens, rather than pharaohs. And the problem is that pharaohs would have had a much shorter lifespan. I think the average lifespan was something like in the 30s, rather than 50s or 60s or whatever people were predicting here. So with just a few pieces of information, we can make quite accurate predictions, but if the initial base rate, the prior, is wrong, then the whole thing is going to be inaccurate. Even if we make the adjustments in the right way to the right extent, the overall judgment, the overall prediction is going to be inaccurate. So it's getting the base rate right that's so important. Now there's something called the base rate fallacy, which is where people don't think about the base rate when they're answering something. And there's this famous exercise or question that's from Daniel Kahneman. He did studies on this, where he's talking about this description of someone, where he says it's something along the lines of they're shy and quiet, they like spending time on their own, reading, so on and so on. And what profession do you think they are? A farmer or a librarian? And most people will choose a librarian because the description matches what they have in their mind as a librarian. But this is the base rate fallacy in play. Because if we think about it a different way, we could start off by saying, how many farmers are there in the world and how many librarians are there in the world? And it's going to be something like this. Librarians, farmers, something like that. Of the librarians, how many of them would match the description? Like maybe you're generous and say, okay, it's maybe this many, like 3/4. How many for farmers? Maybe you're being not very generous and saying, oh, it's only this much because they're actually all very extroverted, which I don't believe. Well, this percentage of this amount is still smaller than this percentage of this amount. So by ignoring the base rate and thinking about the conditional part, so ignoring what should be the prior and thinking about the variable information parts, you're coming to the wrong conclusion. Pigeons just come and sat on my windowsill here. I'm going to come and get a free lesson here. So when we talk about with people's trading, this can play out in many different ways, because if they start off by thinking about what's in favor of the trade in that situation, oh, momentum's running out, it's hitting this path of resistance or whatever, then it's likely that they're going to be estimating based on those aspects and ignoring the base rate, which is that, but hold on a second, this is a 10-to-1 trade. You can't say it's more likely to be a profit than they're not. They're not. I'm talking 1-to-10 trade, 1 risk, 10 return. It's not going to be more likely to be a profit than a loss, regardless of all these other factors. Like, it's going to take a fucking huge situation to overcome those probabilities to make it more likely you end up with a profit. And yet a lot of traders do that. I see on, not that I go on brain rot Instagram trading trading hashtag stuff, but I looked at them for something we were doing a little while ago, and loads of them are like, this 10-to-1 thing has like a 75% success rate. And you're like, you are so stupid. But the people that are agreeing with you in the comments and believing it, I don't know if they are naive or they're also stupid or what. That's not very nice of me to say that. They're not stupid. They're just lovely, innocent people. So that's the base rate fallacy. The second thing that people, and by the way, this also applies when you use your success rate as the probabilities. But that one also ties in with the anchoring effect. And the anchoring effect is basically when you're asked to estimate something, whatever number you start from, that's going to become an anchor. So if you start from the base rate, as it should be, and make adjustments, you're more likely to be accurate. If you start from your success rate, then you're less likely to be accurate. So let's say that the base rate, at least like how we've been doing them earlier in this video, is showing that there's a, I keep doing that, that's showing that there's a 30% probability. okay? But your success rate is 55%. And so you decide to start from here and make your adjustments, or like you're going to adjust down from there until the point that you, with your equivalent bet thing, you're happy. You're going to end up with a much higher probability from starting from there than you would from starting with 30%, even if you're looking at the exact same situation. It's called the anchoring effect, okay? So I say like, okay, there's a trade here. Let's say I take two groups of people, 100 traders, 100 people that are watching this on each side. Hopefully there's 100, 200 people watching this that we can split it up. And on one side I say, okay, I'm going to start a countdown thing from 100%, and I want you to stop this when you think it's the probability of this trade being a profit. And the other ones, I'm going to say, okay, we're going to start from 0% and move up from there. And you'll see that these percentage probabilities are going to be lower than these ones. It's just the anchoring effect. So you've got to be really careful with that. Since the base rates are so important, you've got to start with the right base rate. Have accurate base rates. The next thing is to break the situation or the problem down more effectively. So we have the base rate, then we're looking at all the variable information that influences the base or adjusts the base rate to end up with the end adjusted probability. So first of all, this lovely guy over here, his name is Enrico Fermi, and you may have heard of him probably, I can't write, Enrico Fermi. You probably haven't heard of him in terms of probabilities, probably more to do with science, but he used to come up with problems, interesting questions that are used to this day in like interview processes at Google and places like that, where they'll ask you a question that no sane person has the answer to, but the whole point is that you can break it down to try and figure out like a good guesstimate. So it's not about like when you have a problem or a situation you have to estimate something to say, I don't know. There will always be some things that you do know. So there's an example, I think it was given in Philip Tetlock's book about, there's a question of, I think it might have been from Enrico Fermi. The question is, how many piano tuners are there in Chicago? Something like that. And you go, fucked if I know. Like, who the hell would know that? You start off by saying, what do I think the population is in Chicago? And you might also say, I don't know, because I don't know either. But you might think, okay, is there a city I do know the population of, and how does it compare to that? So maybe you know the population of New York, and you know how more or less what the population is like of Chicago in comparison to that. And you can think, okay, how many pianos are there likely to be? Is percentage of that, how many people have pianos, and how many piano tuners do you need for each piano, or like how many pianos can be covered by one piano tuner? You know, a piano tuner is not just like a like technique or like a tool. It's a person that comes and tunes the piano. No jokes about tuna fish. And you end up with like the end conclusion. And so it's the same with the markets, where if I say, what is the probability of this situation? You could say, I don't know. But there are things that you do know. There are aspects of it that you can say are different to other situations, or are making it more or less likely that a particular move is going to happen. Okay? So you start with what you do know. What do you know about the situation? What can you change the probabilities based on? And then you leave the rest at base rate. So you adjust for those probabilities, or you use those to start figuring out other adjustments that you can make. Oh, if that's like that and that's like that, that must mean that is like that, and so on. Then we see, this always fascinates me. These are Inuit people, and they're building out of snow or ice. And there's that famous factoid that in Western languages, we generally have one word for snow, and Inuits have hundreds. Actually, it's more like dozens, and it's not so straightforward as like they have dozens of words for it, but they do differentiate different types of snow differently to us. We don't really differentiate. You know, here in the UK, if you have snow, really it's just you either build a snowman, or it's like one snowflake's going to cause all the public transport to come to a halt and everyone's going to have snow days. Like, that's the extent of it for us. We're not out there building igloos and whatever else. So for them, because they are using snow and ice for so many different things, like building and different tools or whatever, they need the words to describe the different sorts because they're important variables. So if you have important variables, you need to be able to differentiate between them. So these are the 2 points I want us to keep in mind when we look at the chart again. So if we think about this was this was the trade I took. Is it the same exact chart, or have we changed something here? Okay, so this little gap in between there was where I went and refilmed the bit from earlier where I'd made the mistake with the previous example, which is just embarrassing, but I'm not going to go back and explain everything all over again. So this was the trade that I took on dollar franc. And as I was explaining earlier, you see how the situation was similar. So I could tell like the stop loss was here. I was looking at it before thinking that doesn't look like a 4 or 5 to 1. But I was like, but it's the right chart, so it must be. But anyway, this is the one. So this is the one, and this is like a 4 or 5 to 1. So just to keep things easier, like we were doing earlier, we're basically doing the same thing as before, but 80% chance, it should be the other way around. So 80% chance of loss and 20% chance of return. So it should be the other way around. Okay, so you know earlier when I was explaining it and I was talking about we start off with the base rate, that's this, and then we're making different adjustments. Well, we need different ways to differentiate stuff. So when you look at a situation that you're potentially trading, there are factors that are influencing you to think that that's a potential trade opportunity. There are reasons that you're saying without explicitly stating the probabilities, but when you're deciding to take the trade, there are things that are making you think the probabilities are better than base rate. So you need to be able to differentiate and define those. So for example, if you've got a path of resistance like this, and you've got the exact same situation in two parallel universes, but with one of them, the price approaches it like this, and in one of them, the price approaches it like this, really direct move. You know that one is more likely to reverse and one's more likely to break out compared to the other. Like this one is maybe more likely to reverse than if this has got momentum. I mean, it still could reverse, but it's just the probabilities are different, right? And likewise, if you're looking at order flow, you know from what's showing on the footprint chart, you know from what's in the order book. If you're looking at volume profile, you know from where you are in the profile, and various other aspects, like whatever it is that you're using to trade. If you think the thing's meaningful, there are things that you're counting as variables in a situation, or at least you should be. And if you're counting them as variables that are influencing whether you should take the trade or not, or influencing the likelihood of the trade being a profit, you need to differentiate and define them. So for example, when we're looking at structure, we have structure characteristics, which is basically the speed, length, and depth of pullback. Now, that sounds basic, and you know, it is basic. There are other ways we can get more complex with it, and there are more complex explanations I can give of it, but just to keep things more simple for now. Okay, so now when I look at a structure, I have some ways of defining and differentiating between it. So I could look at this short-term downwards move here and compare it to this, and I could describe the difference between them using these. Okay, so I could look at a write-up of a trade without even seeing the charts and understand what's being described from these things. And that's not just for the sake of it. It's not because I want to read write-ups of trades. It's so that you can start making adjustments for the probabilities and measuring over time how accurate you were with them. Likewise, for a path of resistance, we're looking at strength and dependability. When we're looking at the microstructure at the time of entry, we're looking at a combination of the trend, momentum, and volume. And there are other things, but if there's something that's related to your trades, that's related to your way of analyzing the markets and what you believe is the underlying principles of the markets, you need to be able to differentiate between them and describe them. So you need to figure out how to start breaking those things down, start making an effort to actually do that. Then, we've already covered this, but you can always go through the equivalent bet test and the absurdity test. So let's say that you've made your adjustments to your probabilities. Then at the end, you have this final probability is 64%. Okay, brilliant. Let's take your 64% and let's put it into the equivalent bet test and say like, this is going to be 64%. Which would you rather take, this or the trade? And again, you could say, oh, I'd rather take this. I'd rather take the trade. That was really bad shading. I took a lot more care in my shading earlier, and even that was terrible. But that could be the final test, because the thing is, if you're making adjustments for individual aspects of the trades, like, okay, I'm going to do a plus 1% probability for this aspect of the trend, and plus 2% for this bit, and minus 0.5 for this bit, and so on, the conclusion you might have got to in a somewhat robotic way of doing these individual adjustments. And when you run it through the equivalent bet test, you might think, oh, actually, that's a bit high. I don't think it actually, like, these all together combine to lead to this probability adjustment. So I always say to our members that it's important to assess the individual aspects of the trade, but all of them combine to give the overall context of a situation, and they're not having an individual impact on the trade. They're all like, it's almost like words in a sentence, that together they're giving the meaning, the context of that situation, but you don't interpret each individual word and figure out what they mean and then try and jam it all together. That's kind of what the old school translators used to do, like from Spanish to English or something. You'd end up with this convoluted sentence. So instead it's like they combine to give a context. And so it might be if you approach the probability adjustments in more of a robotic way, what you end up with is far off what you'd actually be comfortable with. So by running through the equivalent bet test, it can make it much easier. And again, the absurdity test, you can also do this on the individual aspects. So let's say you're looking at a certain movement or a certain thing in an indicator that you're relying on. You don't know what to adjust the probability by for that particular thing. Instead, you can start with the absurdity test. Do I think it affects the probability by 20%? No, that's absurd. 10%, 7%, well, it's between 2 and 6%. Okay, it's quite broad, but we can start with that, and over time, collecting the data, we can start to refine it and refine it as you get better at estimating probabilities, as you have more data to use as a reference point, and each individual situation as a reference point. You see, something happens, like let's say that I'm looking at situation A, okay, I've assessed all of this, and then I've got situation B. And situation A, I thought that was a 5% adjustment for a particular thing. And in situation B was like weaker and it was therefore like a 2% adjustment. Then I have situation C and I go, well, it's not as strong as that situation. It's not as weak as that situation. If that was 5 and that was 2, then this one must be like 3.5. And the more of these situations you have over time in your head, you start to build up this database of patterns. I don't mean traditional chart patterns, I mean your pattern recognition machine in your mind, that you can start to more accurately give these probabilities, if we think back to the implicit knowledge that I was talking about earlier. So it comes from experience as well. Then consider potential issues. So this could be things that you haven't considered. So for example, when we had the pandemic going on and any headline was moving prices a lot, or when it was the start of the Russia-Ukraine war or Russia invasion, any headlines would change prices dramatically. So during that situation, you might think, well, these are the probability adjustments I've got. However, there's this big unknown variable that could dramatically change things. So I need to maybe have a wider margin of error here. So let's say that my end probability is 35%, but that could adjust things either way, maybe 5%. So it's going to be between 30 and 40%, something like that. That's percent sign, not a multiplication. Or it might be that you're breaking down a situation and you're basing things on like an indicator down here and moving average, and then you look at the price move and it's high momentum, and you think to yourself, I've got no way of estimating the probability of that or making a probability adjustment based on that. So I might write down that a potential issue is that I'm not able to define trends / price move. And that might be a limiting factor that makes me have no confidence in taking that particular trade at that point in time. But now I know, okay, I need to figure out how can I start analyzing this better? What aspects of my system or in my approach do I need to change, or what skill do I need to develop here? So you consider all the potential issues. So why it feels like I can't say that word properly. Issues, whatever. So that you know, 1, how to improve, 2, what could go wrong with the probability estimate, where it might be inaccurate, and 3, whether you need to have that margin of error, and many other things as well. But we can move on from that one. Okay, so let's say that you have the different ways of differentiating the different aspects, and you have been estimating your probabilities. Well, the next thing is that we need to be consistent with it. And this is a bigger problem than you might think. So there was a lot of research done by this guy here, Paul Meehl, and I'm sure you've all heard of Daniel Kahneman. So Daniel Kahneman was influenced by some work that Paul Meehl did, looking at the consistency or the accuracy of expert judgment. And you'll be able to find online a lot of stuff, a lot of studies and stuff on expert judgment. So they do it without an E. And I'm sure in the UK we add an E here, but I'm going to do it like that because that's what you'll find for the studies. What they found is that in many cases, a formula, or you can think of like an algorithm, but this is like before like proper technology and stuff, but a formula can outperform expert judgment. And they were looking at like judging wines and different things like that. And essentially, it's because there are many reasons, but experts, or anyone, but experts, what matters here, will assess and process information differently at different points in time. So for example, when we say judgment, it's about like, it's not like where there's a black and white answer, it's where you have to give an opinion, a judgment, assessment or something. So with experts, if you give them the same situation to judge at two completely separate points in time, where the second point in time they've forgotten about the first time, they're likely to give slightly different judgments. Okay, so it's lacking consistency. And this is what will happen in the markets. If you give someone a situation that they are perfectly capable of analyzing, so they've got the capabilities to analyze that, and you ask them to give you a probability estimate now, and then you ask them 5 years from now when they can't remember about the last time, they'll most likely give you different probabilities. Maybe they'll be in the right ballpark, but they'll be different, off by, even if it's 1%, it'll be slightly different. Maybe not on that individual trade, maybe if you give them 10 of them, you'll see a lot of them, they'll be different. So what can we do about this? Well, it's all about the order we process information in and the weighting that we give to different information. Like we might weight the impact of them differently from one occasion to another. Now we can't completely get rid of that, but we can alleviate it to a certain extent, and it comes from your trading system. So if you think back to earlier when I said, imagine you could accurately estimate probabilities, you wouldn't need a trading system where you're following some criteria to enter a trade or not, because as long as you can define the potential outcomes and estimate the probabilities of them, therefore you can figure out if the trade has a positive or negative expectancy, you could trade any situation. So do we need a trading system then? Well, what I believe a trading system is for is to make you more efficient at finding the opportunities, and that's not something we'll discuss this time, but they also make you more consistent. And since the aim is to be consistently profitable, i.e. being profitable by using a consistent, repeatable process, and it all comes down to consistently estimating the probabilities accurately, or is that a consistent level of accuracy, the system is going to allow you to do that. Because the system shouldn't just be for, like, a lot of people think of a system as being the criteria you follow for knowing when to enter a trade or when to scale in and scale out. Instead, it should be a lot more focused on the analysis and the order of that analysis to ensure that you're processing information in a consistent way, weighted in the right way each and every time. So your trading system should walk you through the process of analyzing the markets. What do you look at first? What next? What next? How are you looking at it? How are you defining it? How are you making adjustments? All of that kind of stuff. Because then actually when it comes to the trade decisions, well, that's just going to be based on whatever the expectancy calculation is. But this is, I'm going to go off on a little bit of a tangent, but it's related to this topic and it's important. And I do want to speed through the last of this video, so I'm not going to take too long with this. But let's say you have a trade. Okay, we'll do it a different way this time. Let's say you've entered long here because you've done your calculation and you realize that there's positive expectancy, okay, based on outcomes of this and up to here. So let's say this plays out. Now, what action do you take? Do you exit the trade? Well, some people do because they have an order there and like a take profit and they exit the trade. At Duomo, we use a context-based approach, which means that all of our decisions are based on the context at that point in time. When the price gets up here, the way it's moved up there, the interaction up here, various other factors have adjusted the probabilities in some way. So what do we want to do? We want to look at where the next potential outcomes are. Maybe it's down here and up here, and estimate the probabilities of them. Maybe this one's too fast, we choose one that's a bit closer up here and we go, okay, that's 50% and this is 50%, for example. And maybe that's positive expectancy, but not as positive as before. So rather than the amount that we've got at risk here, we want to adjust our risk. We can move our stop loss up here, adjust our risk by scaling out part of the trade and leave the rest open. Maybe it comes out here and then retests from this other side, and now the probabilities are so in favor that it's really positive expectancy, and now we decide to scale in. and so on. And at some point we get to a point where it's negative expectancy. Okay, great, exit the trade, because if you play out those situations over time, you're just going to lose money. So all the decisions become based on the expectancy calculation. So if you think of it that way, what's the main part of the system is analysing the markets in the right way to make sure that your estimates are going to be accurate, that you're assessing the potential outcomes in a consistent way, and that your probability estimates are accurate and consistent as well. And then all your decision making is dictated by that. So what else do you need the system for? You don't. It's that part. So we can talk about the steps in your system in another video. If you want to watch that one, leave a comment below. Also sign up for the free training, because at some point we go through the trading system in that, or join the Duomo Trader Development Program, where literally we cover everything. It's over 70 hours of like really detailed content. Like, I mean, I've really gone to town on like making things evidence-based, covering every aspect of trading that you need based on my experience, helping hundreds, if not thousands of traders, from working with some of the best in the business, from researching for years. Like, I've been obsessed with the markets now since 2002. That's a really long fucking time. Anyway, excuse my sales pitch there. Then we get on to the final thing, and we'll wrap things up after this. So if you've got all of that stuff covered, okay, so you know how to estimate probabilities, you know how to do it more consistently, and so on and so on. The only thing that's left is to develop the skill and to improve your accuracy. So I've combined 9 and 10 on here. So the first thing is repetition and feedback. Now, developing any skill, like, first of all, we have to accept that estimating probabilities is a skill and it can be improved, and that's been shown through research in really complex situations, some more complex than the markets. Some people think, oh, but the markets are more complex, you can't do it for that. You could do it for even more complex situations. Yes, they do exist. So if we accept it's a skill that needs to be developed, to develop any skill requires repetition. Okay, so basically in your brain, you have neurons and they have connections between them. And the way that we develop the skill is when we go through repetitions, then it creates a sheath of myelin around the connections between the neurons. And each time we repeat something, it's giving another layer of myelin. This is called the myelination process. And the more myelin there is around a connection, the more it goes from being like dial-up internet to like super fast, amazing, like futuristic broadband, whatever the hell. I got myself way into an area that I don't know. I don't know if broadband's even the best anymore. Fiber optic, there we go. Or I don't know. Let's leave that there. So you need reps. That's like, it's just a fundamental thing of skill development. Now, there are 3 broad types of practice. You have ordinary practice, you have purposeful practice, and you have deliberate practice. Okay. Now, ordinary practice, if we think about, I always give the same example for this. You're learning to drive, you pass your driving test, and then you spend the next 20 years being a cab driver. After 20 years, do you think that your driving will be at the level of someone like Lewis Hamilton? No. Why? Because when you're driving around, you're just going through the motions, you're not focused, you're paying attention to, you know, hazards and things like that, and the road signs and things like that, but not the skill of driving. So you go into ordinary practice, and essentially what this means is, if we think about this, it's really badly drawn. This is your comfort zone. Got a bit of a lag there. This is when it's too difficult, like I didn't write that properly, where it's like you're not going to be able to achieve the thing. And then this is like, we call this the skill challenge sweet spot. Good luck to anyone who's trying to read this without hearing me say the words. Okay, so ordinary practice, where you're driving around for 20 years, you're in the comfort zone. Okay, no progress happening. You'll gain some implicit knowledge and so on, implicit learning, but you're not going to be really developing the skill in the way that you would if you did purposeful practice, which is where you're in a skill challenge sweet spot. So you're pushing yourself beyond what you're capable of, not too far that is too difficult, because then you're just not going to do anything. You're going to get learned helplessness and not develop. You're in a skill challenge sweet spot, and you go through repetition, and you're focused on what it is that you're trying to develop at a particular point in time. Okay, so I'm going to work on taking the right corner line. Is that what they do in F1? I think so. We're just going to focus on that for a session in a simulator over and over and over and over again. Push myself. Okay, we're going to go faster speeds and get the right line and so on. That's probably not at all what they do, but you get the idea. Okay, so that's the repetition part. So it's about being focused on one area. It's about being in a skill challenge sweet spot, not your comfort zone, and it's about repetition makes it purposeful practice and some other things, but you know, I'm just trying to point out the importance of repetition. The thing that makes it then deliberate practice is a level up from purposeful practice, and this is called the gold standard of practice. It comes from having a coach that has been there and done it and can give you the right sort of roadmap to achieve what you need to achieve, and it comes from getting immediate feedback that you then use to like improve what you're doing. So that's the feedback bit. Now, unless you're a member in our community or something, you're not going to get feedback from me on this and like my guidance, my roadmap, but you could if you want to. But instead, what you can go through, you can get it yourself. Like when we're talking about the probability estimates, we know that it's a case of finding where we're less accurate and improving our accuracy in those areas. So there was this video we put out a little while ago, so a couple of videos back, that talks you through this calibration process. And this calibration process, you're going to gain the feedback through this. So what you're essentially doing is tracking your probability estimates. And then what I talk you through in this video is a process of being able to break it down in different ways to see how accurate you are. So you could break it down by different elements that you're adjusting by, different setup types, different times of day. Maybe you're less accurate in the afternoons than the mornings because you're just not switched on. You could break it down in any way that you want to, just by following the steps in this video. A lot of people pushed back on the ideas in that video. They said it's not necessary or it's snake oil or whatever. But essentially, it's a process that takes all of your probability estimates, which you're doing anyway, doing it in a way that you're measuring it properly, getting feedback on where you're inaccurate or where you're accurate so you can make the adjustments and therefore calibrate your probability estimates. So in some situations you might be overconfident, some you're underconfident. You know where to adjust. So in future, when you encounter that situation, you know the adjustment you need to make. So the way to think about this, the way I think about it, is do you remember like remote control cars? Under the car, so here are the wheels, you have this little thing here. And it's like a little stick that you can move one side to the other. So when the car is like veering from one side or the other, like when the wheel axle or whatever the hell it is, bend or something, and it's like veering to the left, you can change this so it recalibrates it so it's slightly to the right. Then maybe it's veering too much to the right, so you turn the car over and do an adjustment until it's more or less accurate. Maybe it's difficult to get it completely straight, but you can more or less over time get it there. That's what I think of with our calibration process with our estimates. One, the feedback's going to help you improve your like ability, your skill of estimating probabilities. You'll get more accurate from breaking things down in a more refined way. But also, you can look at your accuracy. So if you know like this is perfect accuracy and you're like this with one of the elements or something, okay, from now on, when there's this particular factor involved in the trade, I'm going to reduce my probability estimate down a bit. And it won't be like this where it's two straight lines like that. If you watch that video, you'll see what I mean of like how the chart's going to look. So then you start adjusting down. So when you say, okay, I'm going to adjust by 5% from now on, you do 1%. And next time your line might be here. Now you need to adjust up. So from now on, you go a little bit higher. So it's like 2%. And you get closer and closer. And over time, it's closer to being like perfectly accurate. You'll never be perfect. And the thing with the trades is that we never know with each individual trade if we were accurate because there's only one outcome. Like I said earlier in the video, you can't say it's 60% probability and then it ends up happening and you say, oh shit, I was wrong, so I didn't say 100%. It's over time, you can see on average how accurate you are. That's the only way to do it. So we're not looking at individual trades here, it's the sort of average of them. So that's why it's not a perfect process of being exactly accurate. It's a calibration like the car. If you're just making slight adjustments till you're getting closer to being what looks like accurate. And that's when your trading becomes more dependable. Okay, so I just want you to understand here that you are already estimating probabilities. Okay, you're already doing it. If you're taking trades, you are doing it without realizing it. Or maybe you are realizing it and you're just not paying attention to it, whatever. But you are doing it. You could, at a push, if someone was challenging you on it and asking you questions, define the probability you actually think it is. Then if you measure that, you start to build evidence of whether you do have an edge or not. Now, if that is evidence that you do have an edge, fantastic. Now you're going to have so much more confidence. If you don't have an edge, fantastic. Now you know exactly what areas you need to improve to get yourself to have an edge. Either it's going to be through a calibration process like this, or it's going to be breaking down the probabilities in a better way from having more accurate base rates, breaking down the variables better, or you'll realize that the method of trading you're using is making it impossible to follow this approach. One, it's not allowing you to estimate or to assess the potential outcomes. Two, it's not allowing you to break down the probabilities in any way or like the aspects in any way. And you might realize that actually you're just analyzing something meaningless in the market, or it's just too broad-based, too vague. It's like this pattern is going to lead to a 5-to-1, or just set your stop loss somewhere around here and your take profit somewhere around here. Vague shit that can't be tested. And here's what happens. People will teach you this rubbish. They would never have tested it themselves to see if it actually works for themselves. Maybe at a push they've made some money, but when you watch this video, you'll see like why that's not something to rely on. But what they realize is that if it's vague, when you come to them and say, I've not been able to profit from this, they'll be able to say, well, you need to work on your trading psychology, you need to work on your risk management, or you need to practice identifying the patterns better, or some other nonsense. And now from this video, you can hopefully say, well, no, because if there was an edge and it was objective, then I wouldn't have the trading psychology problems in most cases, and I would know what to do with my risk management, and you are just an idiot. I could have said something much worse then, but we'll leave it at that. So you might decide, okay, I need to change my trading approach then. But at some point, if you've got the right trading approach, you've gone through and figured out like what are the potential issues here and found ways that you need to break things down better, what you're going to end up with is the ability to calibrate your trading, to improve your accuracy. And over time, what you're going to end up with is, to bring it full circle back to the beginning, this. You're going to know you have an edge, and you're going to have evidence of the edge. So you can keep trading, keep trading, keep trading, and then you have this beautiful situation that happens where you have an edge, which means that you trade more, which means that you collect more data, which means that you can go through better calibration, which is going to improve your edge, which is going to lead you to trade more, collect more data, and so on and so on. And this is called a flywheel effect. And I did a video series about this entire thing, 3 videos, including talking about my trading approach years ago. It was when COVID was going on. So I've been talking about this stuff for years, but hopefully now from this video, you can see just how important this is, because if you know you have an edge, you've got evidence of the edge, and you can go through this flywheel effect, your trading will just get better and better and better. So why rely on luck? Why rely on vague things when you can rely on something that's meaningful, that is dependable, and therefore solves these problems? Move more towards the skill balance, no longer lose money on negative expectancy trades, improve your decision making, make it easy to improve your trading through calibration, and no longer have those trading psychology problems. Okay, so I just wanted to go back to this slide to have it on screen as a last reminder while I wrap this up. And I just want to say that if you've made it this far, I really appreciate it, because I know from the last video, it was only a small percentage of people that made it all the way to the end, which is expected, it's a 2-hour video. But if you did make it to the end, I want you to leave a comment, something really specific, and I'm going to pick one of the comments, and that person, if you're up for it, will have a video call to go through your trading, probably spend about half an hour doing it, and discuss how you can implement this process with your particular approach to trading. Or if you're using the Duomo method, we can just discuss, some feedback and stuff for you there. So I want you to leave a comment, and that comment is going to say, "We hate Tottenham." That's the comment. We hate Tottenham. Yeah, I'm petty. So thank you very much for watching. Also, if you have questions about anything that we've gone through here, leave it down below in the comment section, or watch through the video again and see if you pick up the answer for yourself. And either me, someone on my team, or one of our members who have been really helpful can reply to that for you. And if there are other areas you want us to cover in these sorts of videos, let me know. Don't forget that free training and hit the like button and all that sort of stuff, and I'll see you in the next one.